Hello and welcome to the Money Show. I'm Kavita Thapliyal and this show is your go-to destination for understanding money, markets, the economy and the financial decisions that shape our lives every day. This is a show where we go beyond headlines and noise to help you understand what's really happening in the world of business, investing, personal finance and policy, and more importantly, what it means for your money. But today we focus on a growing concern that is quietly becoming a major stress test for the Indian economy. The conflict in West Asia is no longer just a geopolitical story happening far away. Its economic consequences are beginning to spread across energy prices, inflation, exports, shipping costs, currency stability, and even household finances. And while Indian consumers have so far been protected from the full impact through stable fuel prices and policy support, economists warn that inflationary pressures could broaden in the months ahead as companies begin passing on higher costs. So, is India entering a more economically fragile phase than markets currently believe? Can growth remain strong if oil stays elevated and global demand weakens? And are policymakers now being forced to balance inflation, growth, fiscal pressures and geopolitical uncertainty all at once? And what should you as an investor do to, for your financial portfolio, maintain savings or boost up investments? Let's just decode all of this. With me joining are Lakshmi Iyer and Aditi Nayar. Hi, welcome to the show, both of you, and thank you so much for taking time out for this very important discussion today. And Aditi, let's just get the lay of the land first. Okay, I'll start with you. Are we entering the most economically uncertain period India has faced since the pandemic?
Thank you so much. Certainly we are entering a phase which is quite uncertain. There's been a lot of volatility in the last 5 years, and this year is also turning out to be a very uncertain and volatile year. Now, just to give you some context, when we were sitting on 27th of February, economists like myself, and we just got the new series of data for GDP, our first forecast at ICRA for FY27 growth was that it would be around 7.1%. So we were looking at this being a year of healthy growth. And of course, that very weekend, the conflict in West Asia kicked off, and we hoped it would be short-lived, and it's still kind of in a very fragile ceasefire type of a situation. Now, what has happened with all of this is we've had intermittent periods where we've had issues on availability, particularly of natural gas for some time. On the crude oil front, availability is less of a concern, but prices of crude oil itself have been quite elevated, although that hasn't transmitted so far into the retail selling prices of petrol and diesel. LPG and other inputs, of course, have seen prices go up. Interestingly, we had forecast a higher CPI inflation for the month of April than the 3.5% number that was released a couple of days ago. And later today, we'll be getting the WPI inflation, which we're forecasting at 5% for the month of April. So let's see if that number also comes out lower than what we were expecting in line with the CPI data. So as of now, on the inflation side, things are relatively contained, but we do think that inflation is going to rise in the months ahead. And the longer that the conflict continues and crude oil prices remain elevated, it will be difficult to keep the RSPs for petrol and diesel flat. We've already seen one round of excise duty modifications, but at some point, if the retail prices of petrol and diesel also have to go up, then there will be both a first round and a second round impact on inflation, and it will also seep through into the growth side. So as of now, we are looking at GDP growth now instead of 7.1%, which was our original forecast. We're looking at a number which is going to be between 6 and 6.5%, depending on where the average crude oil price finally ends up.
All right. I will talk to you on respectable GDP number later on, but Lakshmi, before that, from a retail investor's point of view. Lakshmi, too many factors at play for a retail investor to get the right strategy. One crisis leads to the other. And how different are these conditions for the market as compared to what you've seen earlier?
Hi, Kavita. I'd say that for a retail investor, or for that matter, any investor, the thing is that the volatile phase is set to persist. That's point number one. Second is that any of these situations, we've been seeing this evolve, it's been almost a little under 90 days, and we've been seeing this evolve. I'd say, what is it in your and my control? The answer is nothing. So if it is not in your and my control, if we do not know when this is going to probably be a final ceasefire, not like a fragile ceasefire, then what you can do and what I can do, or what retail investors, as retail investors, we can do is obviously have control on our behavior. And how is it different from what we have seen in the past? Well, the gyrations of the market remain the same. The situation is different. And I think that is the only thing. But the limited point I'm trying to make is that India, for the foreseeable future, is going to remain a price taker in crude. So any such vulnerability across the globe, whether we originated or no, will definitely impact India, as is the case right now. So I'd say that for a retail investor, not losing sight of your overall goalpost in terms of asset allocation is the most important thing, even in this market, and come what may, that should not change.
We will dissect more on this. Aditi, coming back to the GDP conversation and, a scenario. Could India face a scenario, Aditi, where GDP growth remains respectable, but employment, wages, household finances weaken underneath? Also, what about the structural damage? How close are we to that? How would you analyze that, Aditi?
So I think there's a couple of different things that we can think about. Firstly, how do we define respectable as far as GDP growth is concerned? My sense is that India's medium-term sort of growth potential is probably between 7 to 7.5%. Maybe if I'm being a little less generous, 6.5 to 7.5%. So if I'm saying that this year, with all the global uncertainty that we've seen in the last couple of months, our growth may end up being a little shy of 6.5%, then we're not too far away from the lower end of our potential sort of bracket. But in India, aspirational is considered to be closer to the 8 to 10% mark. Whether that's realistic over a longer period of time or not is a separate question. But are we, in the global context, a 6 to 6.5% growth is also probably going to be quite enviable for many large economies. So respectability, it's a judgment call. What are we talking about in terms of who's judging the respectability of the number? In India, we think 8% is aspirational. For the rest of the world, even 6% may end up being a very good number for their own economies. But for India, of course, the benchmark is higher, and FIIs, for instance, may still want us to be able to post numbers which are better than that. On the employment wages side, it's a different set of questions. I think I just want to bring in that this year also we're looking at a potential El Nino. We don't know how strong that's going to be, and that's something that will affect the rural economy as well. So there may be some sort of spillovers coming out of El Nino and monsoon into what the wages and jobs situation looks like. But in general, I think if you look at between the structural issues that we have right now in terms of the crude oil prices having become suddenly much higher. If you look at the AI related issues that are starting to creep in lots of economies, and El Nino, it may not be the best year as far as jobs and wages are concerned.
All right. We'll also talk about the steps that the government we can look at taking and is also planned in the pipeline. But Lakshmi, before that, let's discuss India's valuation story globally. We've been a major underperformer, looking at the crisis situation and the way Indian markets have performed. But has the premium story changed? Has it been shifted? And are markets and economy pricing in different things over here, Lakshmi? Also, if we talk about the foreign investors, are foreign investors beginning to question whether India deserves its valuation premium in a more fragmented global economy?
So I'll take each of these parts. Are foreign investors questioning? Well, I don't think so, because I think they've also reconciled that whenever they decide to enter into India on a relative basis, they will have to enter India expensive and exit India expensive. That's point number one. Yes, are they relative value trades compared to India versus the rest of the world, not just DM or developed markets, but in emerging markets? The answer is yes. So as a global asset allocator, when I am putting money outside, obviously to use, there are pockets of valuation which are definitely cheaper than India. So that probably explains why FPI money is not likely to come back in a meaningful hurry. And of course, dollar rupee is definitely playing truant on their overall investments. In terms of valuation, I think, if you see India, markets have moved in a range when the Nifty levels were closer to about 22 or 1,000, which we had seen just about a month back. At that point in time, the valuations were more tolerable, bearable, breathable. Now it has got a little bit on the higher side. Is it very expensive? No, it is. Is it cheap? Answer is definitely no. So a twilight zone is where we've gotten into. And the first point that you made, are markets direct from what is happening in the real economy? Well, I'd say that there is a catch-up game probably that is yet to happen, and that is what we will see manifest in the markets over time, because our bond markets pricing in a rate hike. Well, the swap curve is suggesting a 50 basis rate hike. Will it happen immediately? The jury is yet to be out. So I think uh, quarter four, if you see, the results were pretty decent. Quarter one, are we likely to see a repeat? Well, again, it is going to be like a patchy sort of a thing. So I think some bit of catch up of the market reality is now going to happen, and which is what we are seeing clearly underway.
Lakshmi, what is the debt market telling us?
So the debt market is clearly telling you, and we track the swap curve, which is very similar to the Fed Fund futures equivalent, and that is suggesting a 50 basis kind of a rate hike in the very near term. Of course, that has to be looked at not in isolation, but with a whole host of factors. But markets being markets, and that's what the bond yields are reflecting. The 10-year benchmark is trading at approximately 7.05%, and again, that's reflecting a rate hike in the near term.
Aditi, now considering the rate hike scenario, and also if India had to rethink its growth model more aggressively now, would that mean less dependence on imported energy, less dependence on IT exports? The scenario for that is not very good right now, and more domestic manufacturing depth. Again, an infrastructure story out there. Aditi, how would you like to analyze all this?
So if I can just come back on the inflation and the rate hike cycle. So basically when we look at the yields right now, they are elevated, and I suspect they're going to remain elevated because with the kind of situation we're in right now, either inflation will go up or the fisc will have to take the hit. So far, of course, the fisc has taken the hit, and if you presume that this is a short-term situation that is going to resolve itself fairly soon, then the fisc can really be the shock absorber, and you don't let RSPs go up, so you protect the inflation growth side. But if at some point we kind of come to the conclusion that this neither will the conflict resolve very quickly, nor will crude oil prices come down very quickly, then you should take the decision that RSPs have to go up. At that point in time, it will go into inflation and also pull down growth. So it's a trade-off between the fisc being the shock absorber versus it going into worsening the inflation growth dynamics. Either ways, either the fiscal deficit will be higher or the inflation will be higher, and both of them are going to lend themselves to elevated bond yields, even if we think that there will not be an immediate rate hike. So when we look at what the MPC and the governor and others have been saying, I do think that they will look through the shock if the shock is expected to be short-lived, if it's expected to be transient. Right now, it's a supply side issue. It's not really seeped into the demand side. When we look at the high frequency indicators that are available for April, for instance, there are just some instances that you do see of the demand side also getting affected, but mostly right now it's a supply shock. So in that sense, this crisis is very, very different from what happened during COVID. When we go through all the macros, COVID, the impact on the macros was quite different from what West Asia has been so far. And of course, big issues, first of all, we don't know the duration of the conflict. We don't know what price different commodities are going to be at, especially crude oil and natural gas. And the third issue, of course, is the availability. So with all of these factors, we do expect that the MPC will remain on hold for some time. And beyond the next policy, the El Nino, the monsoon factor, all of that is going to come into play as well. And then, lots of uncertainty and lots of moving parts for the MPC to really consider. But at this point of time, we still think that they'll be on hold for at least the next two policies.
Lakshmi, let's focus on the portfolio aspect now. times like these, should investors really be focusing on saving their money more? You did mention asset allocation, diversification, but investment more in equity, because see, triggers are very mixed. The asset class has not been behaving the way it should be. So over there also, we've not been able to see constant returns, and overall portfolio returns, time to just, lower expectation as well, Lakshmi?
Time to lower the expectation, yes, Kavita, but time to move into savings, definitely not, because timing and opportunity doesn't knock at your and my door at our desires and at our timing requirements. Therefore, and I think as cliche as it might sound, but I think that is something which has worked extremely well over decades. Whether you saw, a World Trade Center, whether you saw COVID, whether you saw Kargil, whether you saw multiple such events in the past, they may not be linked, they may not be identical, they may not even be similar. But I think the one thing that holds true is that if an asset class is meant to be, and it is meant to perform over cycles, now the tide is obviously against the sentiment. But if you see the flows in mutual funds continue to be reasonably robust, it can get better. But of course, sentiment is something which needs obviously a fillip. So suggestion to go into savings, definitely not. Staggering your way into the markets and continuing to have a feverish watch on the percentages that you have set for yourself. I think that discipline should definitely not go away. We still remain, I would say, pragmatic as we are. We still believe that the longer term structural growth drivers have taken a small setback right now, and that will evolve and resolve for itself. Of course, the timing can definitely test patience. For all you know, you might have good news as early as this weekend, but we're not planning on the day by day. So I think that's very, very important. And again, I'll go back to Q4. The numbers were not the complete dismal thing. Of course, I do agree that Q1 and Q2 will be extremely challenging and therefore more relevant from a market standpoint. But I think we should not really lower our guard, and we should definitely not make the switches. The timing is not appropriate.
So Lakshmi, in the same context now, what sectors are you banking on?
So, if you look at it from a market standpoint today, growth-led banks, for example, the large private sector banks still definitely have our attention. Valuations have corrected quite meaningfully. You look at the price to book in some of these segments, they're looking quite lucrative. So I think that is some place where we've started adding our positions. We still like the consumption space. We are going to be extremely picky and choosy about what we add in the portfolio. We like the mid-cap IT space, which is not extremely disrupted because of this AI proliferation. So I think it's going to be, we are already positioned in pharma, especially the CDMO space, so that will continue to be a meaningful overweight for us. So I think what we also important to note is that this market is not that you pick up a sector and then you go all in or you go underweight. This is not that kind of a market. This is a market for agility, which I say as money managers is something that we bring to the table. And most importantly, even if you are not bullish on a particular sector, there are stock opportunities which are available, which is exactly what we are doing in this tumultuous space.
Aditi? Aditi, as per your analysis, India's growth story now banking on what? And what strategies are you looking on? What announcements are you wanting to hear now?
Look, I think, we came into FY27 thinking that the domestic side was going to be quite robust. The policy and other measures that were taken last year in terms of supporting consumption growth, we thought that those were going to be able to take us through this year. Now, obviously, some of that has softened a little bit. The government had put in quite a bit of money in the budget for capital expenditure. Some of it might have to be shaved off because of the fiscal consolidation and the overall hit to the fisc from lower excise duties, lower dividends, maybe overall lower tax revenues, etc. But we do still hope that we will end up with a double-digit capital expenditure vote from the government of India, and that the state governments will also be able to protect the amount of capex that they are able to fit into their overall fiscal math. And so hopefully the combination, of the infrastructure resilience along with some amount of consumption. At least in this quarter, the fact that the RSPs have not gone up will protect the consumption side. And then, of course, it's a matter of timing what happens with the conflict and with the prices overall. So these are some of the things that we'll be looking at. In terms of the export side, of course, there will be some niggles this year, particularly in terms of exporting to West Asia itself, which is a material market for us. And on the private capex side, I think the story will remain very mixed. There are some sectors where the capex intentions have been very strong for the last few years. Not only intentions, but the actual movement on the ground. And that's all your new age sectors, whether it's data center, EV, anything that's green, renewables. All of these sectors would probably continue to see private capex. But in the other sectors, I think the mood may remain circumspect, especially given the new set of challenges that the global economy has thrown up.
Right. One last question to both of you. Hypothetically, Aditi, let me start with you. If current trends continue for the next 2 years, what does the Indian middle class look like by 2028?
That's really hard to take a call on. I think current trends means what? That the West Asia conflict lingers for that long and crude oil prices stay at $105 per barrel. AI barrels through and starts affecting a lot more jobs. I think definitely that would have the sort of cocktail as such would probably not be very supportive for the Indian economy. But we are hopeful that at least the West Asia conflict will resolve itself in the foreseeable future, and at least that sort of pain from geopolitics will sort of go away. I think the AI side is something that India will in 3 years or 5 years, given where we are right now globally on the AI side. But I think that's definitely going to be one of the defining themes for India's medium term.
All right. Lakshmi.
The 2 years is a very long time, Kavita. We are living by the day, but yes, since it is hypothesis, let me also give you a hypothetical answer. I say that if this stretches on for 2 years, then I think investors will be so financially impoverished because inflation will shoot through the roof. Much beyond what you and me could imagine, and we are going to be for the foreseeable future, we are going to be price takers of crude, and that's not going to change. And obviously, it will have a significant dent on consumption, and therefore, I think, like how Shiva opens the third eye, I think the policymakers will invoke a third eye and make sure that their measures are as esoteric to ensure that a sharp prolonged nature will definitely have to meet with a sharper response.
Absolutely. And with that, ET Now will be there to help our viewers and investors to navigate through all of these times and crises. But thank you so much, both of you, for taking your time out for this very special discussion today. Thank you so much. Good to have you on the show. And with that, it's a wrap as well. But thank you so much for watching. And any more questions that you want to send across and need expert advice on, do WhatsApp us your queries and the email ID that's flashing on the screen. Goodbye.